The cost of living has been on the rise for the longest time. No doubt everyone feels a pinch because of food, clothing, and housing price hikes. Many people don't realize how inflation influences our daily lives. From what we eat to where we work, inflation has a say. In January 2002, a gallon of gas only cost $1. Today, you'll find yourself paying over $5 due to increased fuel costs, which will likely continue into next year. This event translates into an 80% jump increase in the last 20 years. And yet, despite knowing all too well what causes inflation, the phenomenon where things get more expensive as time goes on, many people still struggle to understand its basics. Hello there, and welcome to the Wealth Monopoly. Today, we'll discuss one of the most misunderstood subjects in economics: inflation. Many individuals think it's a meaningless occurrence. Still, I will show you how it may ruin your plans and finances. So please sit back and relax as we explain one of the most misunderstood topics in economics. Money is such an interesting concept because, as we all know, people trade goods and services for it. We also work day and night for the idea of earning it. However, money doesn't have any value on its own. Its value comes from the fact that we all agree it has value. In 1971, the United States found itself in a rut because it ran out of money. To fix the problem, the government printed a lot more paper money than they had gold. Gold was then the real currency used for transactions between countries. This was like writing a check before your bank account had enough money. America's inability to repay all its paper currency became apparent. Hence, people immediately tried to trade their dollars for gold before the supply ran out. Since the United States was aware that it would run out of money shortly, President Nixon declared on August 15, 1971, that the US dollar no longer would be linked to gold. The US switched to fiat currency, which depreciates over time. A commodity does not back this new form of money. Instead, the Federal Reserve controls how much money is in circulation and, as a result, the dollar's value. When you need to borrow money from the bank, your bank goes to the central bank, which is like a bank for banks. In addition, the central bank determines how much money enters the economy and where it goes. This new flow of funds is causing inflation since money is no longer tied to a certain item. Even though inflation sounds scary for most people, it also benefits today's economy. A slight increase in the price of goods and services indicates that the economy is expanding. Inflation is more likely to occur when individuals have more money to spend. Ray Dalio, an investor, says that spending more money means that other people are earning more. This increase in earnings and demand for goods and services boosts productivity. Businesses may then make more products to meet this demand. This is referred to as the gross domestic product, or GDP for short. The value-added tax, or VAT, is levied on important products to account for the cost of production. In a nutshell, it assesses the country's productivity. Inflation is the effect of rising prices due to an increase in supply. The Federal Reserve prefers inflation to be no more than 2% yearly to keep an excellent economy. However, is there a chance of economic instability if inflation reaches beyond this mark? To comprehend the consequences of inflation on the economy, we must first grasp the many forms of inflation and what causes them. Cost pull inflation. The cost of producing something goes up, and as a result, the price you pay for that product goes up. This is known as cost push inflation, since the manufacturing cost rises and is passed on to customers. Many things can cause supply chain issues. For example, the price of products might go up or the labor cost might increase. When these things happen, companies' cost of doing business goes up. This may also lead to higher prices or inflation. Demand pull inflation. At the surface, demand pull inflation appears to be the good sort of inflation. since it is associated with how people with more money are more inclined to purchase products or services. This results in a spiking market demand that results in an upward price hike. On the other hand, demand pull inflation has a negative aspect known as built-in inflation. This inflation is inscribed in people's behaviors. Customers frequently acquire items before costs rise, believing they will go up considerably in the future. This increases demand for these goods and services, which raises prices and causes inflation. So far, we have learned about the two types of inflation: cost push and demand pull. We are also about to discover that the third form of inflation can be just as detrimental to the economy. Thus, earning passive income could be useful to start now more than ever. For my number one recommendation on how to make money on YouTube, check out the link in the description below. If you liked the video so far, don't also forget to give this video a thumbs up. Now let's keep rolling. High money supply inflation. When the government expands the supply of new money entering the economy, it is said that the price stability has been achieved, causing high money supply inflation. This might happen in a variety of ways. 1. The government may increase the money supply and put it into circulation. Giving money to individuals or firms in stimulus packages and buying financial securities from the open market with newly created money, also known as quantitative easing, are some ways to do this. This encourages new money to enter and stimulates the economy during a recession. This is what happened in 2008 and 2020. The new money is invested in the economy, generating more demand for goods and services. This might assist a nation recover from its problems. However, it also results in inflation. If the government prints too much money, it can lead to runaway inflation. When there is too much cash, the amount of goods and services that people can buy goes down because there is not enough production to meet demand. Creating new money is a difficult procedure for the Federal Reserve. They may produce too much money, causing hyperinflation. The economy may suffer if they don't make enough money, leading to a recession. Number 2. The bank may also lower interest rates to stimulate the economy. Interest rate reductions may be used to encourage people to borrow money. This situation raises the economy's cash, causing individuals to borrow more money. Increased demand, productivity growth, and inflation are all linked to greater supplies of currency in circulation. Again, inflation is a necessary component of the economy's growth, but it must be controlled. When inflation reaches excessive levels, it can lead to several economic issues, particularly when there is high monetary inflation. This can be caused by unforeseen occurrences, such as supply chain disruptions caused by a pandemic. Wages, for example, aren't keeping up with inflation. People's money incomes are instead staying flat. Consumers will have to spend more and more on the same things, putting a strain on the economy. People who don't make a lot of money are the ones who get hurt the most by high inflation. This is because they have to spend more of their money on the basic things they need, like food and clothes. We've seen this recently in the United States, where the government has raised interest rates on borrowed money. Individuals will be less inclined to borrow too much if they understand that selling their homes will not result in money. People will borrow less and spend less due to the higher borrowing costs. When the economy becomes overheated, people cut back on their spending. When interest rates rise too quickly, people may cease purchasing items and services, leading to a recession. This might be difficult for the central bank to manage. Companies can't afford to grow because they must cut expenses, which might result in increased unemployment that could trigger a recession. The central bank tries to control inflation by gradually raising interest rates. However, a few things can cause inflation even if the money supply doesn't change. According to experts, the current inflation is primarily caused by excessive money production and supply chain problems triggered by the pandemic, in which resources, employees, and transportation cannot keep up with the demand for goods and services. Inflation will continue to rise unless these issues are addressed. What are your thoughts? Are we on the verge of a recession? Or will the Federal Reserve be able to keep the money supply in check and prevent us from entering a crisis? Let us know in the comments and subscribe to the channel to be updated for more videos like this one. Also, give this video a thumbs up if you haven't yet. Again, this is the Wealth Monopoly. See you in the next video.